Let's welcome in Peter Cardillo, now Chief Market Economist, Spartan Capital Securities. Peter, what's your view as far as this emergency cut goes, this quantitative easing? Do you think it was expected?
No, I certainly wasn't expecting it, and I don't think the markets were expecting it. I mean, we did expect the Feds to take action on Wednesday, but not as aggressive as they did. And the fact that they opened again, another round of quantitative easing certainly indicates how fast the Fed is now moving and how the Fed is really worried about economic conditions. So it suggests that, the unknown of this coronavirus is really going to impact the global economy in a big way. And I suspect that we're probably in the early stages of recession already. Otherwise, I don't think the Fed would have made such an aggressive move. And of course, once again, the Fed basically took rates down to 0 to 0.025 basis points, and they did rule out negative interest rates. But the fact that they started quantitative easing and a fairly large amount, really suggests that the Fed is worried at this point. And I think that's the reason why we're seeing the market not responding in a positive way. If we look at the futures, they're locked limit down. So, that means that that fear factor of growth rate is certainly on the minds of traders.
Geoff, what is your perspective? Of course, you were writing about the emerging markets when the 2008 QE happened, 2009 QE happened. What is your sense? Is the QE going to have the same impact on the markets at this point of time?
It's a completely different situation, of course, to 2008, and I continue to believe it's not as serious as 2008 because I don't believe we're going to end up with a banking system crisis or anything of that order, which was the driving force of the massive declines we had in 2008. But it's understandable the Fed has acted again. I agree with your previous speaker. I don't think it was necessarily the right thing to use all their ammunition now by cutting rates effectively to zero, by doing a lot of QE straight out of the blocks here. And I think, as I posted after the Fed's rate move just 13 days ago, when you make such a big move like this, when people were not expecting it, there continues to be the usual fear. What do they know about the economy that we don't know? And what are they hearing about the way the system is functioning that we don't know? Recession has begun. There's no question about that. Activity levels are getting crushed across the economy. The question is now how deep the recession is. I don't think it'll last long, but how deep it is. Fed wants to try and get ahead of that, but I still think this dramatic move over the weekend will unsettle people because they will worry about what the Fed is really thinking is going on here.
Geoff, when we just talk about the point that you're saying, is that the reason why S&P futures are down about 5%? That what's really happening?
I don't know, but I think there's probably something along the lines that does explain it. I mean, they're using their full bazooka basically now to reduce interest rates effectively to zero. They've surprised the markets again. They got exactly the same negative response when they cut rates 13 days ago. And I think what it's telling the market is, although lower rates will help certain elements of the economy, such as the housing market at the margin through refinancing, and will ease some of the interest payment burden on certain borrowers, at the end of the day, it's really telling you the Fed is pretty panicked about what's going on. And I think the markets have reacted to that as much as anything. And I think, and you'll see the bond market as well, which obviously is rallying sharply. So I think there's a real sense here that wasn't this just a bit overdone at this point? This, I think, probably does explain this big move down, albeit, of course, we had a big rally on Friday, and obviously the daily volatility right now is immense, as all your listeners know.
What is the sense you get looking at the market reactions? What are markets trying to tell us?
I think the markets are telling us that, we don't know what's really happening in the global economy, and we really don't know what's happening in the American economy. And if you take into consideration the latest steps that are now being implemented here in the States, with schools closings and even perhaps suggestions that we might need to lock down the whole nation. That's a serious. That has serious consequences, and certainly, the one thing that we'll probably be looking at very shortly is jobless claims going through the roof. And that certainly can give us a little bit of an insight of just how prolonged and how deep this recession is going to be. But again, right now it's a guessing game. It's a guessing game for all of us. And that's why the markets are reacting the way they are.
Talk about lockdowns across cities, across countries. What happens in such a situation in terms of numbers? How do you think the numbers community reacts to 2-3 months of lockdown or really no activity across the globe? Jeff, how does
Is that for me?
Yes,
Sorry. Is
yes.
that for me? Sorry.
Yes, Jeff.
Well, I think we simply have never seen anything like this. Certainly in my lifetime, it's been unprecedented, and the logic is that the economic numbers are going to just completely fall off a cliff, and they're going to be dramatically negative. I know, for example, I'm not going out as much. I'm not spending as much money as I do normally on all sorts of things, except possibly food. And I think people are not going to the stores, they're not going to the cinemas, the gyms are closing down. Activity levels across the board, people are being laid off, and as Peter says, you're going to see, tremendous spike in unemployment claims. But I do think we got to keep this into perspective. I think the GDP numbers straddling Q1 and Q2 will be dramatically negative. I have no idea how negative. -6, -7, -8% annualized, maybe more. I don't know. But if through these latest measures that President Trump has very, very, very belatedly taken to try to control the virus, if you start to bend the curve, of the infections, let's say for the sake of argument, 4, 6, 8 weeks down the road, which is of course exactly what's happened in China now, and maybe starting to happen in South Korea as well, activity levels will probably come back relatively quickly. Now, they won't come all the way back quickly, but they will come back quite quickly. So I prefer to argue that this is going to be a deep recession with truly awful economic data, but it may not last that long.
Right, Jeff. Thanks so much for taking out time for us. Peter, always good to get perspective from you.